Welcome to the Risk Reversal Podcast. I am Nathan. That's Guy Adami. It is Friday. We just heard Fed Chair Powell, Guy, give his annual address. I think it's 8 years in a row at the Kansas City Jackson Hole Federal Reserve confab. Market screaming. I know you were on bated breath. That's how you were watching this thing. Give me the 411 because we're going to break down just some of the market movements. But any big surprises there for you?
For me, no, but obviously for the market, yes. I mean, at 10 a.m. this morning, the S&P was trading slightly below 6,400, and he started it. And basically, the market took a green light saying, you know what? We see some of the same things maybe the market has been talking about, and the employment picture is sort of muddying the works a little bit. We still see some inflation risks, but, and I think, the but is we're going to start to think about, again, lowering rates. And I think that's all the market needed to hear, and off to the races we went. Now, the question is this the right reaction? It's a reaction, as Carter will often say. It's not right or it's wrong. It's just a reaction. But, we'll see if this is sort of that blow off top, that last gasp of enthusiasm that the market maybe has been waiting for.
Yeah, it's interesting, Guy, because we were talking about the CME Fed Watch tool and some of the volatility that we've seen for the September meeting a few weeks ago. It felt like it was a near certainty right after we got that July jobs report that they were going to cut 25 basis points. And then we heard a bunch of hawkish talk coming out of some of the Fed governors or presidents, and we saw the 25 basis point cut go down to about 70% or so. So now it's back at 90. And, to your point about the last gasp, here's a quote that I think is important from the statement, or at least the speech. Risks in inflation are tilted to the upside, and risks to employment are tilted to the downside. So that would speak to stagflation. I just want to go through, the Kobayashi letter. It's a good one there. By the way, I'm back on the Twitter, Guy. I've been off for a couple years, and really? I opened that
Welcome
thing back. Well, you know what? It's funny. It's not particularly a great experience. Over the last day, I've been just kind of poking around. I know that there's a lot of new features. Grok is something that people speak an awful lot about and they really like. I don't find any of it particularly interesting. And then some of the discovery on there, and I don't know if you use that or not, it's just not good. You know what I mean? It's just not a great way to see what's going on in the world. And I feel like with Grok, it's kind of garbage in, garbage out. And I'm not saying this in a way that I'm trying to be biased one way or another, but I don't feel like I've missed much. But I went on there for a couple specific reasons. Maybe we'll talk about it later. But this is the Kobayashi letter. He's a great follow, by the way. And I know that you pick out some of the stuff for the market call. So here was the summary that he had. Shifting balance of risk may warrant adjusting policy, suggests downside risks to employment are rising. Labor supply has softened in line with demand. Fed abandoning flexible average inflation targeting framework. I want to get your take on that. Can't take stable inflation expectations for granted.
There's an acknowledgement that the labor market is, I don't want to use the word deteriorating, but is softening. And that is at least mitigated to a certain extent their concerns about inflation. All those concerns have not gone away. But what the market hears is a dovish potential ahead of a rate cut. Well, there's going to be a rate cut. I think it's a foregone conclusion. To your point, we went from 71% certainty, the CME Fed Watch tool, to 93%, I think. So I think that's sort of baked in the cake. But I think people sort of knew that anyway, regardless of what the percentages were. I think it's the tone that has gotten the market this little move to the upside. And I think that's what people were waiting for. I mean, that was hinging on, is it going to be a dovish tone on the back end of this thing, or is it they remain hawkish? And
clearly
the Dubs are winning right now.
Yeah. Do you think, and maybe it doesn't matter either, do you think this has something to do with all the political pressure, do the 25 basis point cut, get in the game a little bit? It probably takes a little bit of the ire off from the White House. And also, we've been talking about this a bunch. I mean, last year, this very week, the Fed signaled that they were going to start cutting rates also for different reasons. And I think that's the sort of important point. And, a lot of folks felt that was political last year. I think the reason that they did it last year, they were much more focused on a weakening labor market than they are right now, but it feels like this has something to do with a weakening labor market, and they seem less concerned about inflation, although they're highlighting the risk. Last year at this time, they weren't particularly worried about inflation. They were worried about a decelerating labor market.
I do think there are people that are auditioning for the next Fed chair without question. But with that said, I don't think this is political in any way, nor did I think what happened last year in September was political in any way. I think it's hard for some people to sort of come to grips with that. People are going to say it's political. There's no way around that. In this environment, there's zero way around it. But I do think they're examining these things as closely as they can. I think they're trying to be thoughtful. I think the statement was probably thoughtful. I think it's both things can be true. I think inflation is still a problem. It is not going away. And I think the job market is deteriorating. And maybe those risks, the inflation risks that they talked about in the Fed minutes, maybe that sort of swung to a 50-50 thing, or maybe a 55-45 thing in favor of the labor market deteriorating. And that's what they're coming around to. And that's reasonable. It's important to be fluid in those seats because the data does change. But I don't think it's political. Now, I have no idea what the administration is going to say, if they've said anything, if they're going to comment one way or another. But what I do find somewhat compelling is the numbers of a deteriorating labor market, which the administration says is fugazi, are the numbers that the Fed is looking at to come up with this dovish stance. Like, the whole thing, if you think about it, is theater.
Yeah, well, I guess contributing to that, Trump earlier this morning took some questions. He was on his way probably to go golf. He was wearing a big red hat, and in big writing, you can't make this up. I mean this. This happened. Go Google it, people. He was wearing a hat that said Trump was right about everything. I'm not lying to you. He was wearing a hat. It was like a MAGA hat, but that's what it said. Let's focus on the stock market before we get to the bond market, because I know you have a lot to say about the bond market here. So, like you said, we are up 1.65%. So the S&P, again, this is 11:30 or so, is trading at 64.75. On August 15th, the all-time high was 64.81. So I think about this. I see a VIX below 15, Guy, and I see the Russell 2000 small caps are up 4%. Okay, so they're more than doubling up that of the S&P 500. As far as sectors, semis are screaming. KRE, BKX. So like the BKX is the entire banking ETF or index. The KRE, regional banks are ripping. It is also worth noting that when the banks were getting off the mat, about an hour ago, JP Morgan was down, and JP Morgan, which has far outperformed a lot of the other large banks, maybe you're just seeing money flow into some of the ones that you have particularly like, some of the laggards, Citi in particular. Transports are doing really well. Materials are doing really well. Home builders are actually screaming. So, we talked earlier this week, Liz Thomas was on with us. We talked about the broadening out sort of trade. Is this a manifestation of that? And obviously we do see mega cap tech rallying too.
Yeah, this is everybody in the pool day. All asset classes are seemingly going to rise on the back of this. And you're right to point out home builders. I think home builders are taking their cue from obviously a Fed that's turned dovish, and they're hoping that somehow magically that's going to help mortgage rates go down, and that's going to, give the reboost or the reacceleration these home builders need. That could happen. I look at gold miners and the gold market and say, okay, there's this deterioration of the dollar that's going to continue that I do think at some point is problematic. We had Jens Nordvig on Fast Money Thursday night, August 21st, and he talked about that as well. I do think it's a policy. I do think it's policy, whether they acknowledge it or not, that this administration wants a weaker dollar. And quite frankly, that also makes sense to me. So I guess around the edges, the things that are moving in sort of the things in my world or my prior world make a lot of sense. It's going to be interesting, though, for me. Now you got a VIX below 15, which they took the wind right out of a VIX that, by the way, I had thought earlier this week and all of last week at some point in the month of August would see 25. That clearly doesn't look feasible right now. But, maybe this is one of those days where you just get capitulation in terms of everything. And then things start to come to some semblance of normalcy. We'll see.
Yeah, so with yields, and let's just talk about this right now. So you have a 2-year that is trading at 3.675. You have a 10-year trading at 0.244. So that's down 8 basis points. The 2-year's down 11.5 basis points. The 30-year is only down 5 basis points, Guy. It's 4.86. And so you've been making this case, and I'd love to hear if you have any updated thoughts here about the steepening yield curve. You've been suggesting that, fine, have a ball. 2-year is going to track, the Fed funds rate, but the 10-year is still, in that 4.25 sort of range. And then the 30-year might be the most interesting to you, where it's not really budging right now.
What the Fed told you is, again, that they're concerned about the labor market equally probably to the inflation picture now. And I'm paraphrasing a little bit, but I think that's what the market is gauged. And maybe they're even more concerned about the labor market at this point, but inflation is still a problem, as they pointed out. I mean, that is not a particularly good situation to find yourself in, because there are really no levers that they're going to pull to sort of figure this thing out. What the market is saying is, well, they've just shifted their stance, and the lever they're going to pull is to help the job market. That lever is lowering rates. Lowering rates is bullish for the market. All systems go. And if for a couple of days that might be the case. But if you start to think about it, if you have a deterioration in the job market, if you have a reacceleration in inflation, economically, that's not particularly good. So it doesn't augur particularly well for earnings and earnings growth going forward. So I think this is just me. I think this is a very short-sighted reaction to a problem that we've been talking about for a while.
All right, so going back to the CME Fed Watch tool, guys, so the October meeting, there's only a 46% probability right now of another 25 basis point cut. That's assuming that we get the 25 basis cut in September. And, we've been highlighting this. Outside of today's speech, we have the August jobs report on September 5th. We have, and again, who knows what's going to come out of that? If you think about, the BLS, head being fired. And again, I'm not going to be a conspiracy theorist here, but you have to assume that, I'd assume that the data is the data, okay? So I don't know what dog you're going to kick if we have another bad print, okay? That's just that. And then we have CPI in the mid-month, and we have PPI, and then we have that Fed meeting. So given all the volatility that we've seen in Fed funds, we might continue to see volatility into that September meeting, depending upon the data. And I am surprised that you don't have a higher probability of an October 25 basis point cut if September, based on the market reaction here, becomes a near certainty.
Yeah, that I can't speak to. It's hard for me to figure out what the market's looking at, but I think to your point, that relative uncertainty about an October cut is probably predicated on the inflation data that we're going to get ahead of it. So I think the market is still aware, again, that although the employment picture is something that now is sort of garnered their concern, that inflation picture is still out there as well. So that, again, potentially mitigates what they're hoping for in October. It's really hard for me, at least, to try to sort of gauge what the market wants or what the market is looking for in terms of rate cuts. But if you just think about it logically, what they've basically told you is the problem that we worried about hasn't gone away. And the one we were least worried about in terms of jobs is something that we're starting to worry about a little bit more. So it's not like the worries have gone away. What the market is championing here is the fact that the worry that gets yields to go lower is getting bigger. It's sort of madness if you really examine it through that lens.
All right, so let's talk about the dollar for a second. You just highlighted, so the Dixie, the U.S. dollar index, back in January was trading at 110. It got as low in early July as, I want to say, 96.5 or something like that. It bounced a little bit back towards 100 just a few weeks ago, and here we are now. Big move to the downside, nearly 1%. I think that when you hear, oh, it's down 1%, this is a currency. You know what I mean? So that is a big move. We're seeing obviously that correspond with the move lower in yields. You could make the argument, Guy, that lower dollar and lower yields is great for mega cap techs
Yep,
and the
that's
stocks
true.
that they're kind of moving the market. Especially, we've heard this again and again about how earnings growth in the first half of this year was far better than expected. It came in around 10% or so. It's important to remember that coming into the year, I think the first half expectations for S&P earnings growth was about 10%. So that got ratcheted down in and around the trade war. I think in early April, you saw a lot of strategists, a lot of analysts on the single stock front cutting their estimates. And now they just came in where they were to start the year, right? So I guess my question to you is if that we're going to handle, at least our economy is going to handle tariffs. And, you keep hearing that it's a one-time hit. I just don't know how you buy that, because we've been talking about the cumulative effects of inflation despite the CPI going from 9% 3 years ago to under 3%. At some point, that cumulative nature is the thing that slows down the economy, because at first, and Fed Chair Powell acknowledges this, some of the least likely to be able to absorb higher prices are the ones taking the hit here, right? Even if it doesn't show up in other parts of the economy. So in the near term, does the economic environment and then what we're seeing in macro assets, does it actually give a big tailwind to the things that are huge drivers of the S&P 500?
Well, it is today. I mean, that's for sure. A lower dollar historically has been a tailwind for the market. Lower rates, obviously, the market views that as a tailwind. Some of the rhetoric around it, market's going to view as a tailwind. What the market clearly doesn't care about are the valuations that are continually just sort of getting ratcheted up. I mean, today, if you want to see what sort of multiple expansion is, just look at today in a vacuum. And that's basically what we've been seeing. There's not like there's any single stock news out there. This is just the market willing to pay more for a dollar's worth of earnings. And I'm glad you mentioned currencies, because dollar yen, I think at one point earlier today was about 148.60. In a straight line, it went down to about 146.80. And then you're going to say that doesn't sound. Trust me when I tell you, that is a big deal. And by the way, that's a similar type of move that we saw in July of last year that sort of prefaced or sort of was the precursor to what we saw in early August in terms of that yen carry unwind trade. I'm pretty convinced that dollar euro, which is I think 117.30 right now, I think it's probably going to sort of creep up, if I had to guess, to about 124. If you want to go back and look, 124 was the high in the euro against the dollar back in, I want to say, February-ish of 2018. You got to go back and take a look, but I think I'm right. So there are a lot of strange things that are happening here in terms of the currency moves, and I think you got to keep your eyes on it. Again, for me to say it today with the S&P up the way it is and with the NASDAQ up the way it is, with the VIX down the way it is, nobody's going to want to necessarily listen to it because it's Friday today. People feel good about things, but all of these things you have to keep an eye on.
So you're saying that people want to hear what they want to hear and disregard the rest.
That's
that was
sort of what I'm saying.
That was so old school.
Simon and Garfunkel,
2021, yeah. We did a bit of that on the pod. Bitcoin rallied 5% nearly in a straight line. Obviously, the dollar.
Same type of move. Yeah.
And then gold. Let's talk about gold for a second, because it's up, 41 points or something like that here. So it's trading at 33.77, Guy. The all-time high was 34.85. So we're not far away from that. It's been in this consolidation for, I don't know, since April, since it broke out during the mayhem.
Pattern,
yeah. So, it's gotten rejected at the level we just talked about. I mean, I know that you think it's going to break out eventually. The longer it's in this consolidation, the longer the base, the higher and what?
In outer space, that of course the great Louise Yamada, who's hopefully watching. Right
yeah,
now,
I mean, so your view is just keep reloading on gold. Like there's not a scenario you see where it melts down.
I'm sure there are scenarios. I don't want to be glib because if I were to say that, I sound so hypocritical because it's obviously, as I try to point out some of the pitfalls in the equity market, and by saying you just reload and then I would say, well, I'm dismissing any potential pitfalls in gold, and I'm not. What I think I'm saying is, given the current environment, and again, given some of these levers being pulled, it's very hard for me to figure out what the bear case is right now in the gold market. Now, you could say that if there's going to be this reacceleration of Bitcoin, it's going to take dollars away potentially, and maybe Bitcoin winds up being the big winner here. That's it. That's an absolute case to be made for being cautious in gold. I just don't think that's going to happen. And what, as I pointed out, and I think you have as well, what's finally starting to play catch up in a really meaningful way are the gold miners, which again, historically people are sort of reticent to pour into because they've been smoked so many times by the underlying commodity. But now I think the market's finally realizing, well, wait a second, this gold move is for real. As we're sitting here right now, the GDX is north of 60. I think it's the highest level we've seen. I think you got to go back almost 14 or so years to see it the last time it was at these levels. So yeah, you know where I stand on that. I'm not going to waver. I mean, I think gold goes higher. I think the mining stocks go higher as well.
All right, so you're listening to this Monday morning. One of the big events next week is going to be Nvidia's earnings. It's on the 27th, and the stock has obviously gotten back on its horse. It's up 2% today. It's up 30% on the year, trading at 178 and a half. And Guy, the implied move, which we were highlighting a little, I think yesterday, and it's come down a bit. It's only 6% now in either direction. So just to do the math on that, if you were wanted to buy an at the money call, you need a 3% move to break even to the upside. Same thing, obviously, to the downside. If you bought an at the money put that expires next Friday, you need a 3% move in either direction. The news today, and the stock was down even before we got the news and the market started screaming that Nvidia, they've basically told their contract manufacturer Foxconn to stand down on making these H20s. These are the chips that they got the export license to sell to China, that the White House is going to take a 15% vig on revenues, to China. Now, this is interesting, and you and I have been talking about this. Their ability just to turn on production after it's been turned off for a while, is something that I think people underestimated, right? And the company has also been all over the place. They had to take a $5.5 billion charge for their inability to sell these chips to China, I think in Q1. All right, so one of the reasons why they are not going to get an import license, okay, which is amazing. I don't know if that's exact term from the Chinese, because Howard Lutnick, the genius that he is, goes on CNBC and he says, he's just bragging. He's like, we're not selling them our best stuff. We're not even selling them our second best stuff. We're not even selling them our third best stuff. And you know what the Chinese are like? Go screw yourself. And then, I don't know if you saw this, but Chinese chip makers are screaming right now. And you use this expression going back a few months. You're like, fine, have at it. Well, that's my line. But you said if you're going to actually keep these chips back, it's going to force the Chinese to innovate. So
I've been saying that, and you've said it. I mean, yes. And we actually thought, at least I want to say, I thought in terms of a policy, in terms of just being strategic, allowing the Chinese to have these sort of lower end chips made a lot of sense, because it should theoretically thwart innovation there. And it keeps them at bay. It solves to a lot of different problems. But then you have this guy talking about how we're basically selling them, a bag of dog shit. Do you not think those things are going to be heard? But it's remarkable to me. It's just not particularly clever, I don't think. I mean, it might feel good when you say it, but it's not strategic at all.
Yeah, he's not the most clever guy. I think most people are in. He's like a blunt tool for the White House. You know what I mean? They kind of trot him out there to say the kind of the harsh sort of stuff or the quiet part out loud. I want to. Well, by the way, I just want to be really clear. I'm actually in the camp that we should not be selling them a lot of our technology, because ultimately,
which is a good camp to be. I mean, that's historically been the right camp, by the way.
Yeah, but Jensen Huang, I mean, he's doing what he thinks is best for the company, which is fine. I just don't think that it's doing what's best for the country, and that is what it is. Much smarter people than me.
That's a good. I like what you did there, and I understand what you did there. Here's what I'll say: it's not his. He should not be worried about what's best for the country, in my opinion. That's just, and then people say, "What are you talking about?" Well, I mean, that's what I'm
I know,
saying.
but my point is though, Guy, like these CEOs know how to get around,
Hundred
a
percent
White House that should be thinking about policy that's best for our country. He went
agree.
to Mar-a-Lago. He went to Saudi Arabia with the president. He went to the White House. He agreed to give them 50% of the sales of to China. If it's going to be that easy to get around what our country's best interests are, it's not going to be hard to replicate that again and again. Tim Cook did the same thing for Apple. Here's another theme I just want to highlight. Workday, an enterprise software company, a SaaS company, reported last night, gave kind of lackluster results and guidance. The stock is trading down 3.5%. It was down a bunch more. I think it was down 6.5% earlier. It's trading very near 52-week lows. The theme here, Guy, is that AI eating enterprise software and these SaaS models. And, the stock is trading, down there at $200. It's trading at 220 right now. And it's down from, and I think you would just call it a double top. It was a 311 was the level. So here we are at 220. And that was early last year. So it never confirmed any of the new highs in the NASDAQ. This is a space that I know it's been in the doghouse. And if you go and look year to date down these entire list of names, they're all down, okay, with the NASDAQ that's up, 13% or something like that on the year, 11.5% or so. I mean, will these things ever get out of their own way? And if we do have a broadening out, let's say the market breaks out to new all-time highs and we're back in this secular bull market, which a lot of folks think, will these things ever join the party?
I think they will, and you're right to point out Workday. It's obviously, not a particularly good day on what is a remarkable tape. But I looked at Salesforce. We looked at Salesforce a couple of weeks ago. Another stock that's been under considerable pressure. I think the all-time high, you probably have it in front of you, is about 370-ish. I think in December of last year. As we're sitting here right now, it's trading about 247. But what we thought was, and it seemingly is holding up. Recently, it traded down to about 232 or so, which was the low that we saw this time last year. It was actually June of last year. And we thought that was a logical level of support. And for now, at least, it's starting to play out. So I do think at some point they will participate. I do think at some point that if you see a pullback in CapEx in AI, these software names will start to win again. But right now, you have a two-pronged attack working against them. You have investment dollars going elsewhere, and you have CapEx dollars going elsewhere.
Yeah, and it's also remarkable, Adobe's a name that we've talked about, and 370 is that level. You got a heck of a memory there in the Salesforce. Adobe, it's almost been cut in half since its 2021 highs. It's never even sniffed that again over the last few years. It's been upper left, bottom right. And, they were trying to make this acquisition of this collaborative platform, Figma, that went public last month, and they were trying to buy it for $20 billion. The deal got scuttled. They go public, $37 billion. So I just think that's pretty interesting. They were trying to do the right thing, you know what I mean? But they were unable to do it from a regulatory standpoint. Anything else that sticks out to you in the equity market before we get out of here? Because it's really hard. When you see a sea of green like this, it's really hard to kind of pick at anything. I mean, the telcos are down as you would expect. Utilities aren't really participating. We saw pharma that was doing pretty well and energy that was doing. By the way, your drillers, the OIH is up 5%. The XLE is up nearly 2%. Aren't we worried about growth right here? And, I'm just curious, are there areas right now, let's make the assumption, and I'm not saying that you and I agree with this, let's make the assumption that we're going to rally into September 5th, right, which is the jobs report. Let's say the jobs report isn't as bad as people think. Now, that is not a scenario maybe where you get further rate cuts, you know what I mean? But let's just say whatever it is, however people twist themselves into a pretzel, they say this is the thing that should cause more rate cuts, and this is going to be good for equities. Are there some sectors that you expect to play catch up?
People are going to continue to point to the banks on this reacceleration, but the one place that everybody's going to, and I have not watched a lot of CNBC today, but I guarantee the chatter around the small caps, again, as you pointed out earlier in the show, up almost 4% today. With the IWM, that's what we look at. And again, I'm not suggesting it's the best structured ETF, but IWM trading about 235, a huge move and now a significant move from the April low, but something that's approaching its prior all-time high that I think we saw back in the fall of 2021-ish, and then again in the fall of 2024. So that's what everybody's going to start to talk about, rate cuts being beneficial for the small and medium cap names.
All right. Well, we got a lot going on here today. I think I'm surprised by the reaction for just the expectation for a 25 basis point cut that, just a few days ago, it was a near certainty that they were going to do it. So maybe traders, investors got themselves turned around a little bit. But I guess, I'm probably more focused on the bond market and yields as you are to see what the front end continues to do, and the back end is probably what you're more focused on. So again, big market day, almost every major risk asset moving around a whole heck of a lot, Guy.
We have a busy week as we sort of wrap up August, which is amazing to say. I mean, a couple of weeks left in August, and then we're right into the fall, and that's when things historically get interesting. So this is one of those days, this Friday, today, the day we're taping this, is one of those days you definitely want to put a bookmark in, because we're going to be talking about this for a while.
Yeah, so if you're listening to this early Monday morning, check us out on the market call at 11 a.m. because we will have a lot to say about how the market closed today, Friday, and how it opened on Monday. So thanks a lot, everyone. Have a great week.